This is the most comprehensive video with examples of buying call options to put money in your pocket fast. It's always good to buy call options on high momentum stocks in a hot market. And with this explanation, you don't have to watch another call option video again, because I'm going to go over some examples and show you exactly how a professional like myself has built a multiple seven-figure portfolio with call options. The trend is your friend and the subscribe button is also your friend. So in this video, I'm going to give you call option strategy, strike selection, and how to close in this video so you can make money trading options. You can have massive growth buying options because they have unlimited potential. For example, if I go into Apple right now and show you buying a simple call option, you will notice that you have unlimited upside. So if I pick an expiration date, April 5th, for example, if you're watching this in the future, it doesn't really matter. These rules still apply if you want to make money. So if I pick a call option, you can see the maximum profit is unlimited. Now look, the beautiful thing about call options is you spend very little money and you get to own hundreds of shares worth of stock with just a few contracts, since each option is worth 100 shares. So when I buy this call option right here, the 180 strike, meaning I'm betting the stock will go to 180 or more, I'm only paying $1.21. This will allow me to control 100 shares with only paying $121. Now look, there is a strategy to this, and I want to talk about selecting strike prices as well as how long of an expiration you should go. Should you go very short-term expiration? Should you go medium-term expiration? Or should you actually buy call options that are longer term? Well, I'm going to give you lots of different examples right now. But look, the first thing you need to know is if you have a small portfolio, you can put 20% of your money, 15% of your money, no problem in call options. But if you have a bigger portfolio, you don't want to put as much money to this strategy because your portfolio needs to compromise of safe strategies. Buying call options is a higher risk, higher return strategy. Therefore, you can't put all of your money. And that's because there are risks. You can lose the money that you put into a call option. However, you can manage your risk very easily because each call option is so cheap. You need to balance this strategy with the other strategies that I talk about on this channel. And that is the key to getting rich and building steady wealth. Now, let's go through some examples. Okay, I'm going to look at Apple right now. Apple has pulled back quite a bit at the current moment that I'm covering this stock. I do really like Apple and have a really large position. So let's go through a short expiration date. So first of all, you can go very, very short term, like 7 days out, okay? If you do 7 days out, the best thing to do is hope that there is an event or that there's going to be earnings, okay, which you can definitely track. For me, I like to buy call options short term if there's earnings 3 days before earnings happens. And that's because during an earnings event, a stock will move a tremendous amount, since the expectation of the market can be very different from the expectation or the actual results of the earnings event. So when I'm buying call options, I'm looking for a higher delta. So let me actually examine one of the deltas here. You can see right now, the delta is 0.23. If you're using a different brokerage, just identify where delta is in your brokerage. 0.23 is a pretty low delta. That means there's a 23% chance of Apple going to this strike price by the expiration date, which is 7 days. So instead of doing this, I would rather get closer and have a bigger delta. And that's because if you think the stock is going up, it's much better to have a higher delta since you will get more participation. And what I mean by participation is if Apple goes up by $1, the participation of this option will be $1 that it goes up multiplied by the delta. So here it would go up by 38 cents. Now, that might not seem like a lot, but 38 cents here is about a 20% move on the option. So if the stock just moves by $1, which is not even 1%, the option will move up by about 20%, which is a really big difference. And that's why buying call options can make so much money. If you're correct about the direction, then you get a lot of movement on the option itself. As long as the momentum is high, which means that the stock is going up, you are going to make money. In fact, if Apple were to go up by $5, then this delta would actually increase by a little bit more than 0.38 multiplied by the 5. And that's because delta is increasing. The more the stock goes into the money, the higher the delta becomes. So for example, this delta right here is 0.38, but if the stock were to go up, then it would increase in value from 0.38 to 0.23. Actually, the mistake that I just caught myself making is that an option as it goes into the money will have a higher delta, not a lower one. And since this one is more out of the money, that's not what's going to happen. It's actually going to be this one, the 172.5. The delta will go past 0.5. And as it keeps going into the money, the delta will keep increasing. So 0.72 and so on and so forth. It'll keep getting higher and you'll get more and more participation. So the more a stock goes up, the more the option will actually participate with the stock. And that's because it has a higher delta because it's very deep in the money. And there's a very high certainty that it's going to stay deep in the money. Now, let's talk about some benefits of going shorter term expiration and longer term expiration. I'm going to use a different stock right now. So I'm going to use NVIDIA, and I'm also going to talk about volatility, because volatility is a very important part of option trading, because a high volatility or a low volatility can really impact your option pricing. So if I go to April 19 right now, and then I go to option that is not that far out of the money. So let's say we go for the 900 call option, okay? You will notice here that the implied volatility is 58, which is pretty high. If you have a high volatility, that means that the option is going to be more expensive. Now, it's kind of like a catch-22, because when an option is expensive, that is likely an indication that the stock is moving up and down a lot. That means there is opportunity to make a lot of money. But at the same time, a high implied volatility alerts investors and traders that they need to have a lot more premium to compensate them for the risk. So here you will see that the $900 call option is worth $58. That is a lot of money. Okay, this is $5,800. Now, granted, $5,800 is much better than owning 100 shares, which would be $90,000. So you still get a really good discount here by buying a call option. However, if you're not correct on the direction, then you can lose all of this money right here. And the high implied volatility is making this a lot more expensive. If the implied volatility was lower, then this premium would go down. So you're basically making a bet. Do you think it's going to go up or down? And the bet gets more expensive the higher the implied volatility. However, this is a trade-off, because stocks with high implied volatility can go up a lot, so you can still make a lot of money. For example, on NVIDIA, the stock has been going crazy. So on NVIDIA, you can make a lot of money, even if you are sort of correct on the direction and the implied volatility is very high, because the stock has been going up like absolutely crazy. So if I go to the 3-month chart, even if you were to spend a lot of money on a call option, let's say back when it was at $492, even if you bought like a $550 call option, that would be expensive. It would probably be worth like $50 or so, right? But the stock went from $492 all the way to like over $800. So if you would have paid $50 and it went to $800, you would have $800 minus $500, which is $300. You have a gain of $300, and you paid $50 to turn it into $300. So you would have a 6x return by buying a call option on NVIDIA, or probably even a lot more than that if you would have just bought it a few months ago. Actually, it would be a lot more than that, because even a couple of months ago, the implied volatility was a lot less. So the premium on buying call options might have been like 25. So you would have had like a 12x return. Now, there is also a trade-off between how long you go into expiration. If you go really short-term in expiration, like 0 days, then you can basically pay a very small price, only $950. The current option right here, the 885, is only worth $950. But if I go into the future a little bit to August 16, for example, 154 days out, you will see that now it's $135. So it keeps getting more expensive. And if I go really far out into the future, like 2026, and I go into the current price, it is going to be even more expensive. So $260, even more. So the whole point is that you want to balance this out. You want to bet on a stock going up with a call option. And for me, the sweet spot is a medium-term option. So I'm not going to go short-term like 0 days or 7 days or 13 days, but I'm also not looking for an option that's like 189 days. I'm going to go for something that is about 3 months out, because for a 3-month option, a lot can happen. The stock can go up a lot, and you can make a lot of money in a shorter amount of time. It is also very emotionally hard to hold a call option, because as the volatility is up and down, you may not know when to close it. And speaking about closing an option, you have to determine for yourself before, and this is so important, before you jump into an option. So before you jump in, you really need to understand, what is my exit point, okay? So for that, what you can do is you can use a simple technical analysis tool like Yahoo Finance. So let's just go into something like Tesla. Tesla has been selling off, and let's say that you want to jump into Tesla using a call option 3 months to expiration, okay? Here's what I would do. All right, so I would go 3 months right here, and you can see that I'm using the Bollinger Band. At the very most, I can only see Tesla really going back up to, the moving average. Here, the moving average is 198. So that's about where Tesla was for the past 50 days. As you can see, the period is 50 days on the moving average. So for the past 50 days, it's roughly $198. And this is going down every single day because it continues to put in a new day. However, I think, right here is roughly what Tesla could be valued at if I were to make a short-term guess. Now, it has pulled back from $200 all the way down to $162. If it were to change trajectory, and if you wanted to jump in and bet on a momentum shift, because you can see here, the RSI is only 28. That's really low. when the RSI is below 30, that is a signal. It is a sign of an oversold stock. This is one sign, the moving average is another, and the Bollinger Band, it's at the very bottom, okay? This stock has really sold off a lot. You can see that there's quite a bit of red volume here. So like multiple days of red volume, a lot of huge red volume back in January 2024 or end of January there. A lot of investors had fear in the stock and they just don't want to hold it anymore. You know, they see a lot of downside movement. But at a certain point, this falling knife will have to recover. I mean, this stock will recover, it'll bounce back. So buying a call option could give you huge rewards because, you know, check this out. I'm going to go and show you the exact example right now of how much money you can make and how I would pick this call option and select it actually. So let's go to trade Tesla options. So look, for me, I think it can bounce from 162.5. Let's say it doesn't even go to 198. Let's just say it goes to 188, middle or the center of the Bollinger Band. So 188. Here's what you'll want to do. You're going to want to pick an expiration day again. You know, for me, you can see that the stock went down from March 1st to March 15th. This is just a 2-week move right here. So for a 2-week move, I can also bet on a recovery in, let's just say 3 weeks. Okay, we'll give it 3 weeks. We'll be kind of generous here. And if it were to bounce back up all the way to, we said about 188, we're going to pick an option. Now, obviously, if we pick the 190, that's just too far out. We don't think it's going to go to 190. And if we go for an in the money option, which by the way, you can do that. You can buy a 150 call. You'll get a lot of participation, but you'll also pay a decent price. Okay, I think what would be better here is if you just go right out of the money. Okay, this isn't too far out, this isn't in the money, it's a good price, 750. Okay, and if this option, basically the break even is 172.5, so if it goes to 180 or even like you can see here, even if it goes to 176, you still already have a 50% return. You can see that on the screen right there. It says $372.92, and that is basically 50% of 750, which you are putting up. But the point where you would double this is, you can see the break even right here is 172.40, and that's because the 165 strike plus the premium that you're paying of 750 is going to be 172.50. I don't know why it says 40. It's going to be 172.50. And then basically for you to double your money, it has to go up by 750 more. So at 180, you would double your money. At 187.5, you would triple your money. So all you really need is for Tesla to first of all break even from 172.5, and then from there on, you know, the sky's the limit. You have unlimited profit potential as the stock goes higher. So look, this would be really good, but you can also go a longer term expiration. So you don't have to do 21 days. You can go a little bit longer. I wouldn't go over a year, but you can go up to, let's say, you can go for 245 days, for example. By the way, you can go for over a year. You just have to be really patient. You have to sit on the stock. And by the way, nobody said you have to hold until expiration. You can always close the stock for a profit anytime that you want. I do that. I do take profit pretty consistently, especially once I'm happy with the return. So for me, how I would get out of this position is once the stock starts swinging up, if it even swings to 180 in the short term, I'm going to be cutting this position. That is going to be my exit point. I'm going to sell that option for a profit. In fact, I've seen a lot of my students, once the stock starts swinging back up from like 162.5 to 165 in a day or two, and they see a profit of 10-20%, they're sometimes happy and they cut the position and make 10-20%. Now for me, I like to let my winners run. I like to let the positions that I'm making money on that are rising in profits, I want to let them run, because taking profit too early can, really hamper your returns. You get a lot more money if you can really just hold that position, have that patience, and let that position really increase in value. So for me, I would want to see a significant swing, and as it would test this point at 177, then I would be pretty happy. I would say, hey, okay, we are approaching 180. I don't need it to go to 188 to be happy. I just will use intuition and say at 177, 178, 180, I will cut the position and make some really good money, let's say 40-50%. But I determine that, a couple of ways actually. As I'm entering the trade, I want to know exactly how much I want to make as I'm entering it, but also, as the trade is in place, I'm also feeling, is this stock going to continue running up? Do I think the momentum is going to continue? How is the technical analysis here? How is the news? How short of a time period? Sometimes if it happens really short term in time, it goes up and I'm up 20-30%, I'll also take profit, right? There's nothing wrong with that. Now look, this is an option expiring on November 15th. If I were to go ahead and buy a call option, what you can do is you can actually turn this into a really interesting position. You can go for something in the money. So here's a higher delta. You can do this. And by the way, I don't know if you knew this, but call option that you're long right here, this is a little bit more expensive. You can also sell call options on it. Okay. You can actually generate income on this position while still betting that it's going to go up. So as the stock is going up, you can still bet on it going up and create some income. This strategy is called the poor man's covered call strategy. And if you want to learn more about it, here's a video that you have to watch that I made explaining exactly how to open a poor man's covered call and manage and close for profit.